fast-paced montage of neon-lit Times Square, luxury shopping, and swipe sounds. Suddenly, the music cuts to a low, ominous drone. Zoom in on a single plastic card on a dark table. It weighs 5 grams. It's made of PVC plastic. And for 47% of Americans in 2026, it is the heaviest thing they own. Right now, the United States is sitting on a mountain of credit card debt that has officially crossed $1.27 trillion. That isn't just a big number. It's a record-breaking disaster. We were told these cards were financial tools. We were promised cash back, travel points, and flexibility, but for millions, that plastic has turned into a digital shackle. In the last 5 years alone, balances have spiked by 66%. Today, we're going inside the machine. We're going to look at the math that ensures you stay in debt, the psychology used to make you swipe, and the terrifying reality of why in the modern American economy, the debt trap isn't a glitch. It's the business model. Let's talk about the minimum payment. It's the most dangerous phrase in finance. Imagine you have a $5,000 balance at the current average APR of 21%. If you only pay that minimum every month, do you know how long it takes to pay it off? A timer starts counting up rapidly. Nearly 15 years, and you'll end up paying over $6,500 just in interest. You bought a $5,000 couch, but you paid for 2.5 couches. The banks don't call this debt. They call it revolving credit. And they love revolvers, people who carry a balance. If you pay your bill in full every month, the bank actually calls you a deadbeat. Host voiceover. Why? Because you're not profitable. They want the person who is stressed. They want the person who has to choose between a car repair and the credit card bill. Because that's where the 29% penalty APR lives. That's where the $40 late fees live. There is a biological reason why you spend more on a card. It's called the pain of paying. When you hand over physical cash, your brain's insula, the part associated with negative emotions and physical pain, actually fires up. You feel the loss. But with a credit card, that feedback loop is broken. Research shows people are willing to pay up to 100% more for the same item when using plastic instead of cash. And the industry knows this. Think about the evolution. First we swiped. Then we dipped the chip. Now we just tap. And with Apple Pay or Google Pay, you don't even need the plastic. You just look at your phone. Every step of innovation has been designed to remove friction. They want the distance between "I want that" and "I bought that" to be zero. But here's the darkest part. This isn't an equal opportunity crisis. High-income earners get the travel rewards and the 1% cash back. They're essentially being subsidized by the people at the bottom. If you have a Subprime credit score, you aren't getting 5% back on groceries. You're getting a card with a $300 limit, a $95 annual fee, and a 35% interest rate. According to 2026 data, over 60% of people in debt have been there for over a year. 22% say they don't think they'll ever pay it off. For these people, the card isn't for luxuries, it's for survival. 41% of current debt is driven by emergencies, medical bills, car repairs, or home leaks. We've replaced the emergency fund with emergency plastic. And when the emergency hits, the interest rates ensure that one bad day stays with you for a decade.